Andrew Page. G'day, mate. Welcome to the Australian Finance Podcast.
Owen, I'm pleased to be here, mate. Always a pleasure.
Yeah, it's always great to chat. For those who don't know, Andrew and I are mates. We go way back to the Motley Fool days. But Andrew, you've since started a website called Strawman, and I bet that some of our listeners are already quite familiar with it. But tell us a bit about Strawman. When did you start it? Why do people go there? Like thousands of people go there. Why? What is it? What's so good about this place?
Well, it's funny. It's like a lot of things. It's sort of, you have an idea and then it evolves and you pivot and you tweak and that kind of thing. But it was actually launched a public beta version back in early 2018. And I guess the problem we were trying to solve is that, and I'm sure a lot of your listeners know this, there's a lot of stuff online when it comes to opinion on investing and finance and the rest of it. It's just a very noisy place, and it's just really hard to know who to trust. You know, everyone's Warren Buffett on Twitter, you know, and so it's like, well, maybe you are, probably you're not. But so we wanted to sort of have a platform where people could share ideas, test their own thinking, all that kind of stuff, but that we just put accountability around it. So you've got like a play money stock market portfolio that you can paper trade the ASX, and it's a bit of experience, and hopefully help you gain a bit more confidence with all that kind of stuff, but also to help build a track record and build credibility. And so yeah, and just recently, really in the last few weeks, we've launched Strawman Premium, and the way to think about that is really we get rid of all the sort of the tech jargon. Is we're just an investment club. We're an online investment club, and like any investment club, whether it's around a kitchen table or like us, you're on a platform online. It's just about connecting self-directed investors together, sharing ideas, leveraging the collective experience and wisdom and intelligence of the crowd, and hopefully arming people to make better, more informed decisions and get better results. So that's what we're all about.
So you can go online, you can get a free account at strawman.com. Hey, why is it called Strawman? It sounds like a scarecrow.
So I'm a really, this is like a fundamental belief of mine when it comes to investing, is that the best way to improve an investment idea is to challenge it. It's very bruising to the ego, but I do kind of feel as like, look, dude, you're either right or you're wrong, right? And if you're wrong, the stock market is going to show that to you. It will reveal that to you in the course of time, one way or the other. And that's going to result in a painful financial loss. So if it is wrong, I want to know before that happens. And I would rather that it be my ego that gets a little bit bashed and bruised rather than my portfolio. So the idea with Strawman, or the name of Strawman, is that we want people to challenge ideas. We put up your idea. What do you think's worth buying? You know, tell us, you know, how much do you think it's worth? What's the investment thesis? What are the risks around that? And then hopefully people can come and sort of shoot it down in flames in a very respectful, polite way. I'm probably not doing a great job of selling it here, but you know, it is immensely powerful. In fact, we run this thing called the Strawman Index, which just takes the portfolios of all of our members and just aggregates it together. And it's done something like 40% compound return over the last 3.5 years. And I think a big part of that is because of this collaborative sort of environment we've got, but one where people can challenge each other, again, respectfully and kindly, but with that view in mind of trying to get a firmer idea of your investment case. So it's either, so as I say, it either knocks it over, in which case you either sell out or don't invest in the first place. That is a huge win. Or it helps strengthen that idea. And when that's the case, because even if you've got the best investment idea in the world, it's never going to go up in a straight line. And so it helps you with your emotional fortitude. It helps you stay true when things get scary and volatile. So when you've got a great investment, you buy it at a sensible price, and then the market being the market, you know, hands you a big serve of humble pie and it drops 20% the next day, or we have a global pandemic, or, you know, an Icelandic volcano erupts, or any kind of external factor happens, it gives you the conviction to actually, I'm not going to sell. This is great. In fact, now it's cheaper. I might even buy more. Whereas you and I both know, mate, that generally speaking, the human nature is such that in most cases, what you'll want to do is you will doubt yourself and you will sell. So strengthening that conviction through challenging is why is a long answer. That's why it's called Strawman.
Yeah, I like it. And of course, I like it. And it's great to see you now being such a success with it. I think it's just, minimum viable product, as they say in startup land, has well and truly passed. So today's conversation is an interesting one because we're not actually talking necessarily about stock market investing, which is for the most part our jam. Today, we're going to talk about property. We're going to step over the fence and we're going to talk about the difference between renting and buying. And I thought of you when Kate and I were talking about this because a few years ago, you went on a bit of a Twitter, shall we call it, rant?
Let's call it what it is. Let's call a spade a spade.
Yeah. And it got picked up. I think it was picked up by the ABC. You got interviewed and there was all this stuff going on. So maybe just to start off with, can you, just from a big picture perspective, maybe you can explain your journey? Like, how did that Twitter storm come to be?
So, like you, mate, I've been investing in the share market for a long, long time. I walk the talk. I'm a firm believer. I think it's just the best arena to grow your wealth. Generally speaking, I think you and I both know this. When you speak to most people, the share market is seen as a casino. It is seen as something that is really risky. And there's movies like Wolf of Wall Street and all, everything in popular culture sort of reinforces that. And let's be honest, I forget who said it. It might have been JP Morgan, the man. But if you treat the market like a casino, you'll get the same result. And most people do, right? So it's this highly speculative, very risky kind of place. However, as you and I also know, is that if you take it seriously and you approach it conservatively, it's actually really, really great. And all the studies show this. And there's some great charts out there that just show you, it puts the share market up against the other investment classes and it outperforms. It always has. It's more volatile. That's the price of admission. There's no denying that. You don't get anywhere, and that's why it's seen as riskier. But risk and volatility are two separate things, I would argue. But anyway, it's a great vehicle for long-term wealth creation. So I'd been investing for a long time, almost 20 years, and I thought, well, wait a sec, I've got when I look at my personal balance sheet, most of my money was in my house, like most Australians, and houses are great. Let's not be negative on housing. Housing has actually been a wonderful investment in recent times. But I felt that, well, actually, I've got this debt against it. I could just sell the thing, take all that equity, invest it in the market, again, sensibly and conservatively with a long-term focus, and then rent. And then when I love a good spreadsheet, as you know, Owen. I went way down the rabbit hole and I reached the conclusion that even though rent money is quote unquote dead money, that given the extra capital I've now got deployed in the market, on a net basis, I'd actually be better off. In fact, I would compound my wealth faster. 10% on $10,000 is $1,000. 10% on $1 million is $100,000. So, the returns might be the same percentage wise, but the dollar returns could be very different. And that was my hope. And that's actually been borne out by my experience. So on a dollar basis, where we've done better than had we just left our money in our house and just had a small amount left over in the market. So that was the thinking. And that's why I did it. But the Twitter storm was one of regret, because although that has been true, what I didn't factor in, and this is the big mistake that I made, was that, and this doesn't fit neatly into a spreadsheet, is the emotional turmoil that comes with that. What you don't have as a renter in this country is security. So if anyone is renting out there, I'm sure a lot of listeners are, good luck finding a landlord that'll give you a lease that's more than 12 months, maybe 2 years if you're lucky. So we have had 5 houses in 7 years. We've never been in a house for more than 2 years. We get kicked out all the time. Let me stress, we're good tenants. I've never missed rent. We've never damaged the property. The reason we kept getting kicked out is because the owner wants to sell or renovate or put their kids in there or something, factors that weren't relating to us. And that's what I didn't factor in. So, and we've got 2 young kids. We've got school zones and all of that kind of stuff to consider. And just anyone who's moved knows it is the worst thing ever, moving. And so that was my regret. And that led to the Twitter storm. It's sort of like, hey, so I sold my house. I sold my house to invest in the market. It's actually worked out well financially. It has not worked out well emotionally, because we have no sense of home. We feel as like every place we have is like an Airbnb, and it's just been really, really frustrating. And so the Twitter rant was about sort of talking about that experience and just talking about the really, as I see it, silly policies that are around housing and renting that really disadvantage renters. And, I think you're seen as a bit of a second-class citizen as a renter. The reason the ABC picked it up, this is the interesting thing, that when it was on 7:30, the journo kept on coming back to this idea of like, wait. You had a house? Yeah. And you on purpose, like, decided to sell? Yeah. Like, why would, that was the angle that they wanted to come at, because it was just seen as like the most, no one does that. No, why would anyone ever do that for? Because it is an ideology in Australia. Home ownership is the dream, the great dream. Australian dream, And so for anyone to, people, the story of people having trouble getting into the market is a well-known one, and in fact a very important story that needs to be told. But the story of the person who's in the market and voluntarily elects to leave the market, that's really weird. So yeah, that's what that was all about.
So there's a few interesting things there. We had one question come through from our Facebook community from David, who asks, why even get a house at all? Or at least, why get an expensive one when you factor in maintenance, renovation, council rates? Shares historically win. Everyone's different, but it's the feeling of security, I guess, that it provides, especially for kids. So the first one you said before, like about the money component of it, and you referenced investing, effectively taking that money, investing in shares, right? Would that trade-off, just from a financial perspective, we'll get to the emotional side of it in a sec, but would that math still have worked if you were starting out as an investor? Because a lot of the people that think about housing in a negative light are trying to save that deposit. So they're like, they don't have, 100,000 or $1 million. They have 5, 10, 20 grand. And, I guess, would that, if you were in that situation today, would that influence your decision? Like, would you still go and save a deposit for a house so you can get that leverage, so you can get in? Does that make sense?
Yeah, it does. So this is going to be hard to do verbally, but the variables that matter here. So the answer to your question is it depends. So if you're going to buy a caravan in at the back of Burke, it makes a huge amount of sense, right? Because you don't have to take on much leverage. You'll pay it off really quickly, and then you'll be rent and mortgage free. And then you'll have all of your disposable income to put into the market. And the maths just works out beautifully well. If, on the other hand, you're wanting to buy a 3-bedroom brick house in the inner west of Sydney or Melbourne or something like that, and you literally need $1.5-2 million to buy that house, and you have to borrow 95% of that, and you have to pay mortgage insurance, and you have to pay rates, and you have to pay this, and and all this stuff, then probably not. The other big X factor in that is, you and I are sitting here right now with interest rates at the lowest levels they've ever been. And if they stay at this level for the next 30 years, then that is a big plus for property. If it doesn't, let's say interest rates go up 1 or 2%, that changes things massively. Now, if we're at an interest rate environment of 8%, it went to 9%, well, that is less attractive. But when you go from sort of 1% to 2%, you're literally doubling your mortgage repayments. So that's the other thing. So it depends is the answer. I would argue at this point in time that we have this as humans, and this happens as much in the market as it does in property market, is that we have a tendency to extrapolate. So we look at recent history and we just push that forward. And you'll hear people say, "Oh, property doubles every 7 years," and property never goes down, and all of these kinds of things. Well, actually, that's not true. I did it. That's another tweet I sent out. I went to the ABS and I went back as far all the property records they have. But actually, over the last 20 years, I think I'm going to forget the figure now, but something like 4%. In gross terms, not real terms, not inflation adjusted terms. Still a great investment. The great thing about property is it's got utility. You can live in a house. You can't live in a share portfolio. So there are other considerations with all of that. But it's something that is it's something that I think is dangerous for people right now to think I can comfortably take on a massive amount of debt and I will double my money. Particularly, I know people who rent but have an investment property. Now, wrap your head around that. And they're happy to do it, even though they're not even making any money on it. In fact, they're losing money. In fact, Owen, they're intentionally losing money because of this strategy called negative gearing. And they do that quite happily because if the price of the house goes up, if the capital value of the house goes up enough, you can actually make squillions. But this is true of anything, right? So imagine if I said to you, "Hey, Owen, I'm going to take all the money I've got. I'm going to go take out a margin loan." So for those that don't know, a margin loan is a loan that you use to buy shares. And I'm going to actually, margin lenders don't let you borrow this much, but let's say I found one that did. And I said, I'm going to leverage myself up 95%, like 20 to 1. For every dollar I've got, I'm going to borrow another $20, right? And I'm going to put that all in the share market. You would think you are the craziest fool that ever lived. I don't care what blue chip quality shares you're buying. Things can go wrong with that strategy. And I would just urge people considering it with property is that there's a couple of things, if you're doing that, you need to be comfortable with. One is that leverage works both ways. So if property goes down, and believe it or not, I know it doesn't feel like it in Australia in the last decade or so, but the global experience and the longer historical experience says actually it does go down. That can wipe you out. You still have to pay back the amount of debt that you've got, but your equity is absolutely gone. So you can lose a lot of money doing it that way. Here's the other thing too, particularly if when you factor in the real cost of ownership, that is, you factor in all of the money you have to pay just to keep the house, rates and maintenance and all the other kinds of things, is that in fact, even if it only goes up 1 or 2% per annum, you're probably still behind as well. You've taken on a huge amount of leverage. There's a massive interest component to that. Interest rates might go up. That's really the talk on the market right now, is inflation risk. And it's a risk because if inflation goes up, that will mean interest rates go up. So it's just, it's not about me sitting here today forecasting this stuff. I think this is where a lot of economists and financial punditry goes wrong. Oh, this will happen and it will happen by this extent and by this date. I'm not that smart. I can't do that. I don't think anyone can. But it is about saying it could. And if it does, then what? So you always, in any investment, whether it's emu farms, shares, or property, I think you should, as an investor, spend a good deal of time thinking about, yes, obviously there's a bull case there. There's an investment case to do something, but look at the case for not doing it and be comfortable with that as well. There might be an asymmetry here of sorts, that if everything goes swimmingly your way, you make a bit of money and that's great. But if things go against you for whatever reason, for any unexpected reason that was foreseen or not foreseen, what happens then? And we are at a situation, I would say, just talking in aggregate about the average scenario across Australia, that if interest rates go up by any material degree, if house prices fail to increase at the historical rate that they have in the future, a lot of people are going to be in a huge amount of pain. Now, maybe it doesn't happen, and I don't want to be silly enough to forecast it, but if it does, you need to be comfortable with that scenario, particularly if, like a lot of people, you're spending every last cent of savings that you have just to service the damn thing. And this is something that, even under the best case scenario for a lot of people, is a 20 or 30-year commitment with a mortgage to pay this off. So you never get sick, you never lose your job, nothing ever goes wrong. Great, you'll do okay. And I would say, okay, you're not going to be shooting the lights out. Anyway, that's a long answer, but I think you need to think about all those things.
Yeah, fair enough. So if you were 20 years old today, and you didn't have, or say you're 20, anywhere between 20 and 25, right? and you've got it drummed into you, you've got to get a house and whatever. But you've got 25 grand. So you can make a choice. I could save up for the next 3 years and buy a house, or I could start investing in shares, knowing that I won't be able to access that money, and I'll go rent. Just as simple as that. Which option do you reckon you would take?
It's a hard one. I think, as I said, what you have to, and this is where I went wrong, what you have to consider is the emotional side of things. So if you do decide to go invest in the market and rent, you have to unfortunately, you have to have a preparedness that there could be a lot of upheaval in your life in terms of having to move all the time. It costs a fortune to move, and it's a pain. And your furniture never fits the new house, et cetera, et cetera. It's different too. Like, I think if you're in the market for a 2-bedroom unit, it's a very different market than it is for someone who's after a house. We've got 2 kids, 8 and 11. So, we wanted a house, and that's, as I understand it, that's a very different, it's a much more difficult market than 2-bedroom units, which are just falling out of the sky at the moment. They're everywhere.
Yeah.
So you probably have a lot more security. So you have to factor all of that in. And if you do decide to go with the property route, and by the way, there's nothing, I've kind of been a bit negative on it. There's absolutely nothing wrong with that. I would just say, if you do go that route, just make sure you don't overstretch yourself, because for all the reasons I just said, you don't want to be wiped out.
So, and now let's jump forward a few years. So that was the younger person. Let's say you going back, and this is where we can touch on the emotional side of it again, is the decision that you made to take the chips off the table and invest. Would you have made that exact decision again, or would you have done something slightly different?
I would have done something different. With the hindsight's 2020.
What I
would have done is I would have kept the house, and I would have drawn down against it.
So like a line of credit.
Yeah. Yep. Now the advantage, now that's still borrowing money to invest, but the advantage of doing it that way, as opposed to doing it with a margin loan, is that you don't experience what's called a margin call. So under a margin loan, if your level of equity drops too much, the broker will just force you to sell your shares. You become a forced seller. But with the alternative that I'm talking about, it's actually held against the value of the property. So even if you suffer a 50% fall on the market because of a bear market or a crash or something like that, you're not a forced seller, and you can be there for the recovery. In fact, you can probably put more in. So yeah, I would have gone that way. And I think if I had gone that way, I think if you add it all up in terms of dollars and cents, I probably would not have made as much of a return, but I would have had a much less stressful life. And that's something.
Yeah. So just to confirm for people there, so typically in a margin loan, when you get a margin loan through your broker or whatever, it's secured against the shares in the portfolio.
Yes.
But if you use a line of credit, that's the bank is effectively saying, if your shares don't work out and you can't repay your loan, we'll take your house.
Yes.
And that's better in some ways, because then if the shares fall, which we know they do because of random gyrations, you don't have to then go and sell the shares, which the broker would force you to do if you had a margin loan. And there are pros and cons to that, to be sure. But if I was going to do it, that's the way I would do it too.
Yeah.
Assuming that you knew how to invest. I think that's the big asterisk here is you understand how to invest and you're prepared to invest that way.
I think actually there's a really great analogy. I think I invest in the share market the same way I would invest in the property market. That is, with a view of probably 5 years plus, having done a bit of research on knowing the quality of the suburb, whether the foundations are firm, whether there's any white ants in there. Same kind of, to stretch the analogy, are there white ants in the balance sheet here? Or what kind of suburb / industry is this business? Like, you've got to approach it very, very sensibly. And it takes work, as you and I both know. But yeah, if you really want to treat it seriously and properly.
There was another question that came through from Sean, our Facebook community, who said, how do you think about accumulating investments and renting until you can buy somewhere to live and pay a mortgage? So would you prefer to invest in shares and keep renting? What's your ideal scenario? So I guess you kind of just answered that in a way.
Ideal scenario would be that we had a European system where there are much more protections for tenants. Honestly, I don't know. It sounds like a bit of I've got a persecution complex. Maybe there's a bit of truth to that, but you are really treated as a second-class citizen as a renter. It's just sort of like, anytime you ring up the real estate agent because something breaks, it's sort of like, what have you done? It's just, it's a really horrible, it's a really horrible experience. So if we lived in a world where if someone said to me that, and I get this, Owen, I've actually put this to all of our landlords. I've said, you've got an investment property. I'm an investor. I get it. You want security. You want visibility of future cash flows. How about this? Let's sign a 10-year lease. And within that lease, I'll put in a clause that says that every year we increase the rent to either in the rate of inflation or the level of average rental income in the city. Whatever's the most, I'll do that. So you have a guaranteed clause of rental rises. And I have security of tenure. I know that I'm going to be able to live here. And if I know I'm going to live here for 10 years, there's a lot of perverse incentives come into it. So often, friends or family come around and say, oh, look at this. You got great space out the backyard. You're going to put a nice garden in, or, oh, look at this. You could really do a lot with this space. Like, why would I? Why am I going to spend any effort and time and money to plant a nice garden only to be kicked out in a year and then probably lose a bit of bond because I've dug up the dude's backyard? It's really weird, perverse incentives. So yeah, I think the system is broken in Australia when it comes to rentals. But if we had a good,
what would they say? We had a good put that to them.
No, we don't want that. No. Huh. I think the assumption is you're going to do something stupid. You're going to ruin the value of their home. I don't know. And I would sort of say, well, dude, we pay you a lot of money each week to live here. It's our privilege to do, we don't want to, obviously we don't want to destroy your house. It's your asset. I get that. I don't want it. But by the way, I live here. I want a nice home. It's not in my interest to ruin the place either. In fact, I want to make it nicer, but you can't do it. I mean, we've lost money because we put a picture up on the wall. A little bit of paint chipped off, or more often than not, the landlords put some crappy kitchen in from IKEA or somewhere like that. And just in the day of using it, and the handle falls off, you lose bond on that. It's like, dude, this is wear and tear. This isn't reckless. We're not cooking crack here in the house. This is, people live here, and every now and again I might drop a fork on the floor accidentally, and that might be, but that's why we pay you rent, to compensate you for all of this. It's a really, really bizarre scenario. I forget your initial question.
No,
another rant.
That's fine. So here's an interesting question. So imagine that I'm using a younger person as an analogy because as example, because a lot of the times younger people do feel the weight of the Australian dream the most. I think once you move on, once you buy a house and you realize it's not all it's cracked up to be, you're like, oh, geez, I wish I didn't stress about this so much. Yeah. Here's a question that was sent in. It says, what should I do if I'm in my early 20s and I want to go do things like travel, but I'm being pushed by people around me to buy a home? What would you, if you're in that young person's shoes, what would you say to get your parents off your back, to get friends or family? Like,
yeah, it's hard, isn't it? There's so much. It's like, it comes back to this, what I said before. I mean, it is an ideology here. It is a religion in this country, and people are coming at it from a really good place, particularly the boomers, right? Because they've had such a wonderful experience with property, and they want what's best for you. And they bought when they were young, and then now they're sitting on a gold mine, and they want you to have the same thing. Now, when they bought, average house price was 3 or 4 times average income. In Sydney and Melbourne, average house price is 12 times average income. So even though they might want to complain that interest rates were higher when in their day, the multiples were very, very, very different. But anyway, they're coming from a good place. So that's the first thing to acknowledge. The other thing I would say is it's not a binary decision. There is, as a Buddhist would say, there is a middle path in all of that. You can have the experiences that you want, do a bit of travel and enjoy. I mean, what does Buffett say about, you want to invest for the future, but you don't want to do it too focused on that. He says it's like saving sex up for old age.
Yeah.
You've got to enjoy yourself on the way through. So there is a middle path here. I would sort of say you don't want to be the kind of person who blows through their 20s and 30s without ever having saved a cent or having done anything to plan for their long-term financial future. You'll regret that. I remember being 20, and a long time ago that was, but you just think I'm never going to be 40 or 50 or so. It's an eternity away. But sadly, here's reality: you're either going to die before then, or you're going to get there, right? And if there's one thing that we know in investing, you take away all the fancy, complex stuff. The best friend that you have is time, and time is the friend of compounding, and compounding is the friend of wealth. And so you really want to do something now. So yeah, on one hand, you don't want to just blow through it all and have a great party lifestyle and then just be, have a really miserable middle and older life. At the same time, you don't want to be the person who only eats 2-minute noodles and toasted cheese sandwiches and puts everything in the market. Yeah, you'll be mega, mega, mega rich when you're 50. But life's there to be lived, right? Maybe you get hit by a bus tomorrow. So I think there's a balance there. Whatever you do, just don't put yourself into a corner where you are so overstretched that you are losing sleep because you're worried about meeting your mortgage repayment, or every time on the, the first Tuesday of every month when the RBA meets, that you're just desperately you're refreshing your newsfeed to see if the RBA has lifted interest rates by 0.25%. Because if it does, you'll be on the street. You do not want that lifestyle. Unfortunately, this is the problem that the boomers don't understand. I don't think is that for people in that scenario, it's the way that things are structured at the moment is that the only way to get into the market is either you're privileged enough to come from a family where mum and dad can give you a couple $100,000 to help you do it, or you get into massive, massive, massive amounts of debt. That's how you get into the property market. Or you just wait and save and scrimp and save, and then finally maybe get a deposit and then buy and then have this massive rock of debt around your ankle for the next 30 years. So it's a massive dilemma. It is a huge dilemma, and there's no easy answers for it. The pollies keep talking about housing affordability, and there's every single policy and approach under the sun to improve housing affordability. Let's cut through the weasel words, Owen. Housing affordability, if you want to improve it, means prices going down. That's what improves affordability. But if you do that, if you do anything that does anything to impact that, you're going to wipe out 2/3 of the country. You plunge the economy into a massive recession, and you get voted out quicker than anything. So this is the great unspoken truth that is out there. Everyone knows that this thing is broken, but what do you do? What do you do? You either we've encouraged so many people to sort of leverage themselves. We're one of the most highly leveraged property markets in the world, one of the largest property markets in the world, despite our size. The only way to fix it is for prices to go sideways for a long time, or to prices to pull back a little bit, and that is going to hurt a lot of people. So you let people access their super. So you give grants to first time. You do all these things, but there's a real perverse outcome to that, which is all that does is make houses less affordable. Drives up prices. So it's kind of it's a really diabolical situation. I don't have any easy answers.
I would say the easiest answer for a lot of those people in that situation, and this is kind of the conclusion that I've come to a few times, is just invest. It doesn't matter where you do it or how you do it. Maybe, except I probably wouldn't put it in something like cryptocurrencies, but go out and invest. Yeah, maybe a little bit. Yeah, a little bit's fine. Sure. Yeah, but don't be saving a house deposit in shares, cryptocurrency, or anything else that's risky.
Yep.
And if you do go down that road, just find comfort knowing that you are actually doing something with your money. So it's not, even though you might be renting or whatever, you are actually doing something. Yep. And that is actually, like, emotionally, that's a really positive feedback loop. And it might just be the case that it takes you 10 years to buy your own home, but at least you're investing and you're making money, you're putting money to work in the meantime anyway. And I think another way people can do it is, if there's like in a couple, is have your brokerage account set up. So you're buying shares and you're investing that way in ETFs or whatever you're doing. And then also have a property account that you just automate just a little bit of money every month, and just so it feels like you're getting ahead. Because the one big concern for a lot of people is that because of that leverage you talked about earlier, the property market seems to be getting away faster than you can save up. There's one more thing I want to talk to you about here, mate, is like when you think about where you are now, have you considered buying a house?
Yes, I have. So I'd like to really do it in the next couple of years. But it's the same. So I'm 46, Owen. Depressing but true. And
Very young.
Yeah, thank you. Thanks for saying. It takes a little lot longer to get out of bed these days, I'll say that much. Well, my personal situation is such that having started the business, it's actually much harder to get a loan.
Yeah, it is.
That's the other thing. The other one is that I'm actually on a pretty good thing with my investments, and the last thing I want to do is sort of, it would depress me a lot to have to sell everything and then put that into a house, because I would gain security, but then I would lose this beautiful compounding machine, which is just doing really well for me.
Yeah.
So I'm trying to personally get to a stage where I can do it without taking on too much debt. I'd like to, well, ideally I'd like to just buy a house without having
in cash,
a bank.
Yeah,
just buy it in cash. Isn't that unheard of? That just doesn't happen. But yeah, I might be in that situation. Speaking of extrapolation, but I might be in that situation in a couple of years if the market continues to be kind to me, and that way I can sort of have my cake and eat it too.
Yeah. Well, that's exciting stuff, mate. That's exciting.
Can I just say though, it ain't going to be a waterfront property with 6 bedrooms. You know,
What do you mean? You're the founder of a startup and you're a professional investor. Surely it is.
No. And you know what? I'm actually a really simple person. I don't the trappings of well, I don't need a fast car. I don't need a boat. I just want a nice place that we can raise the family. 3-bedroom brick home, bit of a backyard, job done, right? That I'd be as happy as Larry if I had that scenario. I'd much rather have that, but and be in a situation where there's no excessive leverage or risk that can wipe us out. So no matter what happens in the economy, I can sleep pretty soundly at night, knowing that I'm not gonna lose everything if interest rates go up, or the great thing about a house and having a small or non-existent mortgage on it is that, think about that, the return there is insane, because what you would otherwise be spending on paying an interest or paying on rent is in your pocket. It's a guaranteed return. I've got a couple of friends who have houses and they've got these massive mortgages against it, and they have an investment property. And you think, but and then they go, oh, maybe I've got a bit more equity, I'll buy another one. Again, this sort of stacking things on top of each other works really well in an appreciating housing market. But my urging to them is, actually, you know what? Why don't you just spend that money and pay off your mortgage? Because being in a situation where you're mortgage free, that is, so some of these guys are paying $800 a week in interest. Like, wouldn't you rather? I mean, think about having $800 in your pocket each week that you could invest or do whatever you want. That is a return in exactly the same way as anything else would be considered a return. So anyway, that each to their own, but that's the life for me, is a low stress life where I can live mortgage or rent free.
I think that's the key. And I think it's good. Like you talked about, like, people listening to your story would probably think that you're a bit jaded and a bit critical. I think the word is critical, but I think that's right. Sometimes in my experience with a home too, is like, I don't really care for property, to be honest. I'm going to share my story in a few weeks, so maybe that'll be cathartic for me too in a few weeks. But I'm only 1 year into our house buying journey, and I never felt the urge to buy one. And I've got to admit that, as great as it is, being able to just knock down a wall if I really want to do that, knowing that the consequences probably take about 5 weeks to patch up, it's much easier to knock things down. I think from a spreadsheet, from a financial perspective, it's always made sense to me to be an investor in the stock market. It's just always made sense. Or businesses. It doesn't have to be,
Mm.
that's what we're doing. when we
Same
invest in
thing,
property.
right? Yeah.
Or you can go and invest in a private business, whatever.
Yep.
That has always made more sense to me. But I also understand the emotional side of things, and then where that comes from, particularly with a family. Yeah, and it was also really interesting to hear how you kind of backed out the numbers. I think one of the things that we always get asked is, saving on a mortgage versus investing in shares. I think the big consideration that people have to take into account there is just the tax, where you pay tax and where you don't. If you pay off your mortgage or you have an offset account, which is probably the way I'd do it, have an offset account, you don't pay tax to save money on interest. But if you invest and you get dividends, you do pay tax on capital gains and dividends.
Good point.
That's a fair trade-off. But we've covered that in other podcasts as well with the mortgage broker, Chris Bates. But mate, I think this is awesome. I think we also didn't do a great job of introducing Strawman at the top of the show. I think people should go there. It's strawman.com. You can create a free account. So for any of our investors in the audience, we've got tens of thousands of them. You can go on a Strawman. It costs you nothing to get a free account. And you can have, like Andrew said, a play money account, basically, where you can pick which share that you heard about or which ETF that you heard about on the stock market. And you can say, I'm going to put 10,000 of my fake $100,000 in that and see how it goes. I think it's a brilliant way to introduce people to the stock market. And it's so much better than the ASX game, which is like 6 or 8 weeks. This is like, you can see how you would have done over years. Like you said, 3.5 years is where you're up to now. So you can try out that really daunting thing, which is investing. Maybe you're thinking, do I save for a house, or do I put my $5,000 or $10,000 in the stock market for the next 3 to 5 years? Let's go and start that journey by, let's just open a Strawman account and see what it feels like. So yeah, strawman.com is where you can find out more of what Andrew's been working on, mate.
Can I just quickly add a couple, I know we're short on time, but just add a couple of quick things on that. So we've just transitioned to this premium model. So the free site is you're going to be a little bit restricted in terms of the content that you can see there. So we're in the process of polishing that up. So please bear with us. What you can do, which you've alluded to, is you can paper trade the market. The other thing that you can do is that you can use Strawman as an investment diary. Yeah, and I really think that's more important in a lot of ways. What the share market can teach you the wrong lessons. I've got friends who started investing just by happenstance at the start of a bull market, and it's very easy to convince yourself that you are Warren Buffett. So when it's that rising tide lifts all boats kinds of things, and you can, in the share market, you can be right for the wrong reason. So you can buy a share and it can do really well, but for no reason that you deserve to do well on it. It was just luck and right place, right time kind of stuff. So what I would encourage you to do, if you, unfortunately, premium is closed at the moment. We're not accepting new members, but if you go there and you open up a free account, by all means, have a bit of fun trading the market. But I would encourage you to, on these reports, write down the reason that you're buying the company. Write down the risks as you see them, write down some notes, maybe on manage, all the kinds of things that you might want to look at. And by the way, I know you've covered this extensively with all your podcasts, so we're not going to go into it now, but do that as an exercise. Will be far more valuable than just saying, oh, after 3 months, I happen to be up on this, highly speculative stock, which can give you a false sense of confidence. Yeah. Treat it seriously and make sure that the things are going well for the reasons that you thought that they were going to go well, not because it just happened to turn out that way, because you can learn the wrong lessons in this game.
Yeah, but property doubles every 7 years, Andrew. So
of course it does.
These rules matter. These rules of thumb. Wonderful, mate. It's always a pleasure to speak with you. So thanks for coming on and sharing your story. Really appreciate it.
Always a pleasure. Thank you.